Real estate is often described as passive income, both by people on social media and the mainstream media when they're talking about ways to generate extra income or as a side hustle. But is real estate really passive? The answer is actually not that simple. Some real estate strategies and tactics are incredibly passive. They require almost no work, while other approaches are basically full-time jobs or could even be more than 40 hours a week. But often, the more active types, when you put more effort in, earn the best profits. So the question really becomes, which approach is right for you? And in today's video, I'm going to break down the 3 variables that you should consider when deciding if passive investing is right for you. First, we're going to talk about what deal types you're interested in. Those are things like flipping versus short-term rentals versus long-term rentals. Second, we're going to talk about deal finding, like how you want to go about finding properties to invest in. And third, we're going to talk about your management style. And I'm actually going to just pull out a whiteboard and start ranking different strategies and different tactics and different ways to think about passive versus active investing. And hopefully this is going to help you decide for yourself where you fall on the spectrum, because there's no right answer. You know, I started my career on the really active side of the spectrum where I was self-managing, I was house hacking, and I was doing a lot to earn every extra dollar. As I've grown as an investor and found more success, I've become more passive because as you get a certain amount of properties, it becomes more difficult to actively manage everything. And honestly, I just don't want to spend all day thinking about property management. And so I do some active deals still and some passive deals still. So there's no right answer. It's really about thinking through the different variables that I'm going to go through and deciding for yourself, like what part of the spectrum you want to sit in on. So with that said, I'm just going to pull up my whiteboard here and we're going to talk through it. All right, first let's start with deal type. So some people call this strategies. I call it deal type because I think strategy is a much broader thing than just what kind of deal you're doing. That's a digression. So let's just go into some of the most popular types of deals. And of course, within each of these deal types, there's going to be a spectrum as well. Like not all flips are going to be more as active as other flips, but generally speaking, I'm just going to rank them on the scale of passive to active. So long-term rentals, I think falls about here. And maybe I should have put numbers here, but if we put passive as sort of like, you know, a 1 level effort and active as 10 level effort, I'd say that long-term rentals are probably like a 3 or a 4. Maybe when you're first getting started and you're not as good at operations and systems, which is fine, by the way, it might be more active. But I think over time, as you get good at being a long-term rental investor, it's honestly not that hard. Short-term rentals, I would say, are sort of like a 5 or a 6. It's definitely more effort than a long-term rental because you are in the hospitality business. You have to be interacting with guests. You have furnishing. Honestly, I own a short-term rental. Things just break all the time. It does take more work than a long-term rental. But again, the upside for short-term rentals is probably a bit higher than long-term rentals if you're a good operator. Lending is something I've gotten into recently, you know, being a private lender, and that is like almost entirely passive. You do have to do some underwriting at the beginning of your deal, but once you do that, it is super passive. And so if you want to be pretty hands-off and you have the funds to be a private money lender, it's a great way to be pretty chill and still be able to. So if you have the funds and you want to be in real estate but don't want to do that much, lending can be a great option for you. Next, BRRRR, I would say, is like a 6 or a 7, but you know, that's just for the initial part, right? When you're doing the renovation part of BRRRR, which if you don't know stands for buy, rehab, rent, refinance, repeat. Basically, during the rehab process, when you're fixing up the property, that's a lot of work. So that's like a 6 or a 7. But once you refinance it, it just becomes a regular long-term rental. So it goes down to a 4 or 5. But the total overall effort is a bit more active than a regular, you know, long-term rental. Lastly, flipping, probably not surprising here, but I would put this as like a 9 or a 10. Like if you are actively, you know, a flip just requires a lot of work. Renovating properties is complicated and it requires a lot of attention. So I would put that as an 8 or a 9. I didn't put development on here like ground up construction, but I would even put that at the highest at 10. It's just not that common for our audience here at BiggerPockets, so I didn't put it on, but that one's even more complicated. Sometimes flipping's more complicated. I don't know. But so if you want to just think about, okay, if I want passive income, I would probably focus more on the left side of the spectrum here, right? Lending, long-term rentals, short-term rentals. You can do BRRRR, but just know that the initial part is going to be pretty intense. Meanwhile, if you're like, hey, I got a lot of time and I want to maximize my profits, then any of these are possible for you. You can get into flipping, get into BRRRR. Great ways to make money. They just take more time and they're definitely not passive. All right, so that's the first variable, deal type. The second variable is deal finding. Now, there are tons of different ways to find deals, and let's just talk about them. One is off-market deals. So this is basically when you do what I would call direct-to-seller marketing. And people call it, you see people doing driving for dollars, which is actually driving around and identifying properties that you want to buy, contacting the seller, hopefully negotiating with them. Some people do direct mail. Some people do social media marketing. Whatever it is, all of these off-market strategies take a lot of time. It's kind of a business in itself because it's all a volume play. You can't just expect to send out like 3 postcards and get a motivated seller to sell you something at a discount. You've got to be doing this all the time to try and generate what are great deals. Off-market deals can be very lucrative, but you have to work for them. So that's why I'm putting them on the more active end of the spectrum. Next, we have networking. And if you haven't heard of this or thought about it, it's just a way to generate deals by knowing a lot of people in the real estate industry. And you can find off-market deals that way. And networking takes some work, but it doesn't have to be as systematized as off-market deals. Like off-market deals, you have to be tracking your ROI. You need to be making sure you're getting the right volume out every day. Whereas networking, if you regularly go to meetups, if you talk to your appraiser, your agent, your lender, all these different things, you're going to be building that network. It still takes time, but it isn't as active as off market. Next, we'll talk about tools. Like for example, at BiggerPockets, we have a deal finding tool, and that I think is the easiest, right? This is where we at BiggerPockets have created a tool where you can go on and you can look for properties that are on the MLS. It's kind of like Zillow, but it tells you the potential for cash flow, the potential for appreciation for every single market. Or for every single deal that's on the market. And so this is a very easy way to find cash flow. The last is agents or MLS. This is also relatively easy. I'll just put it next to tools. I think those are somewhat similar. One with an agent, you're reaching out to an investor-friendly agent. You can find one at biggerpockets.com/agents. But finding an investor-friendly agent who's going to find you great deals, curating on-market deals, the tools are sort of similar. It's another way to curate on-market deals, but you're just doing it yourself. But both of those, I would say, are on the most passive side. So tools, agents, you're going for on-market deals, but trying to narrow down from all the houses that are out there, which ones actually make good investments. That's actually more passive. But if you're willing to do the work and do a lot of networking and off-market deals, you might get a steal. Like you might get a home run deal, but you're going to have to work for it. Again, no right answer, but you want to consider this when you're thinking about where you want to fall on the spectrum. The last is management style. So the first two are sort of like before you buy the deal, but management is once you actually go and buy the deal, how are you going to handle day-to-day operations? So self-management is of course the most active, and this is true regardless of what deal type you pick. So if you're flipping and you hire a GC, it's going to be less active. But if you're doing self-management where you're GCing, general contracting the project yourself, that's basically a full-time job. And so that's basically as active as it can get. That is true for every different strategy. If you're self-managing everything to do with your operations, that's going to be super active. On the other end of the spectrum is turnkey. So this is like basically where you hire a property manager to do most of the work for you. You can hire a full service property manager and they will, deal with tenants. They'll do all the financials. They'll do the reporting for you. And that can be relatively passive. You still need to manage the manager. Like I have some properties where I have a full service property manager. I still have to meet with my property manager. I'm still emailing them a couple times a month. I get on calls with them. It's not super intensive in terms of time, but you still have to put some time into it. There's a sort of a hybrid between these two, which I call hybrid, but that's basically where you do some of the management for yourself and you hire a property manager to do other parts. So for example, when I moved to Europe in Denver, I continued to do the financials and I continued to interact with tenants a lot, but I hired a maintenance person to do, when something went wrong, the maintenance person would go to the property and interact with the tenants in that regard and make sure everything was fixed and up to snuff and all of that. And so you can find sort of a hybrid. And the good thing about this is it can take on almost any form that you want. You can sort of customize whatever management system that you want, but I'd put that somewhere between turnkey and self-management. The last one is syndications or funds. They're kind of both. They fall into the same thing. But this is really for people who are accredited investors. If you haven't heard that term, the government sets these criteria for accreditation, which is generally speaking a net worth of over $1 million, excluding the value of your primary residence. Or if you're an individual, you make $200,000 a year or more and have for the last few years. Or if you're married, $300,000 a year or more. And the reason this matters is if you are an accredited investor, you can more easily participate in syndications and funds. This is basically where you provide money to another investor to invest for you. Syndication, usually you're buying a single deal like a large multifamily asset. You're pooling your money together and having what's known as a general partner, an operator, go and do the whole deal for you. It's a similar idea with a fund, but instead of you just buying a single asset, you're sort of buying a bunch of assets, spreading it around, diversifying among different properties or different asset classes. Similar idea though, you're giving your money to someone else to invest for you. And while there's still a little bit of work here, but it's all up front. Like you just figure out who you want to give your money to and you got to do that work. That is super, super important. But once you figure out who you want to invest with and you write the check, you're pretty much done. I mean, I do this kind of investing myself and I attend, quarterly webinars and information sessions about how the deals are doing. I ask questions, but I'm not involved in the day-to-day. In fact, I can't be. I can't make decisions about the property. I can offer opinions to the GP, but they can take that for what they will. They're going to decide how to operate and run the business for themselves. So those are the three criteria I think about when I'm talking to people about where they should be on the active to passive spectrum. What kind of deals, what deal type, how do you want to find deals, and where do you want to be in management? And when you think of these three things in total, that's how will tell you how much time it's going to take you. So for example, on one end of the spectrum, if you want to be get into a fund for lending. I do this. I am in a lending fund. It is as passive as it gets, right? I have given over my money and I thankfully, knock on wood, have been getting my income back every single month. And I honestly do nothing, almost nothing for that. I did a lot of vetting of the operator to start. Meanwhile, if you're self-managing flips and you're doing off-market deals, like if you're doing driving for dollars to find flips that you're going to self-manage, that's at least a full-time job. I would think that's 40 hours a week minimum, if not more. If you find one of those deals, you're going to do great. It's going to do way better than my lending fund in terms of ROI, right? Because the more active deals tend to get the better returns. But I work full time. I have other professional interests. And so I sort of, at this point in my career, sort of stick around the middle to the left side, but I try and achieve a balance. So I do more hybrid investing styles for my long-term rentals. I have a turnkey operator, full service property manager for my short-term rental. For my lending and my multifamily investing, I do syndications. And so I've created this sort of portfolio of investments that allows me to spend something like 20 hours per month on investing, which is relatively passive. When I first got started, I was spending probably 20 hours a week on investing, right? And it really just depends on your personal preferences, your finances, your family situation, where you are in your investing career, and all of that. But hopefully this information has helped you think through what different types of deals you should be looking at and what different types of real estate strategies can work for you, given how much time you have and how much effort you want to put into real estate investing. All right, guys, that's what I got for you today. I'm Dave Meyer for BiggerPockets. Thanks for watching.